In consolidation accounting, we combine a parent company's financial statements with its subsidiaries into one set of consolidated financial statements. Now, consolidation isn't as complicated as you might think. It comes down to 3 steps. First, we adjust and eliminate, then we combine, and finally, if applicable, we adjust for the non-controlling interest. In this video, I'll walk you through the entire process using a real parent and subsidiary balance sheet in less than 10 minutes. In this example, we have Monroe, which paid $3,293,000 for 100% of the outstanding voting stock of Maine Corporation. And at the time of acquisition, Monroe determines the fair value of the assets and finds that the buildings are undervalued by $355,000, but also finds that the licensing agreements are overvalued by $160,000. And we can jump right in and consolidate Monroe and Maine. The first step is to adjust Maine's assets to fair value, and we'll start with the buildings, which have a book value of $1,890,000, which we will step up to the fair value of the building by adding $355,000. Next, we'll adjust the licensing agreement's book value of $3,730,000 down by $160,000. And that brings us to the allocation of the purchase price, which basically just means that we figure out how much Maine Corporation's net assets at fair value were worth and calculate if Monroe paid more than that amount. In that case, the overage is goodwill. We start with the amount paid by Monroe of $3,293,000. And we subtract net assets Monroe received for it, adjusted to fair value. Maine's assets are $6,309,000. Now we'll adjust for the fair value increase of the building of $355,000 and for the fair value step down of the licensing agreements of $160,000. We subtract the liabilities of $419,000 for accounts payable and the long-term debt of $3,290,000. For total net assets received of $2,795,000. So Monroe paid $3,293,000 and received net assets of $2,795,000. Sometimes there are unrecorded assets like research and development and process, but that's not the case here. So because the amount paid of $3,293,000 is greater than the net assets received, the difference is classified as goodwill, in this case $498,000. And we add the goodwill amount of $498,000 to the adjustment and elimination columns as well. Did you notice that Monroe's trial balance still shows the original investment in Maine? Let's eliminate that next. So a credit of $3,293,000. Since Monroe acquired all of Maine's voting stock, we need to eliminate the equity section of Maine's balance sheet next. We'll start with Maine Corporation's common stock of $1 million. Next, we eliminate Maine's additional paid-in capital of $500,000 and Maine Corporation's retained earnings of $1,100,000. And our adjustment and elimination columns balance at $3,453,000. So we've adjusted Maine to fair value and eliminated the investment and equity accounts, but how do we actually get to one consolidated balance sheet? And that's what we'll do in step 2, combining the parent and subsidiary balance sheets now that we've completed the adjustments and eliminations. First, we combine the cash balances for Monroe and Maine, $452,000 and $174,750, with no adjustments or eliminations, which is $626,750. Accounts receivable combined is $2,006,000. Inventory, $1,493,250. The investment account in main sub is now 0. Buildings after the adjustment is $8,117,500. Licensing agreements after the adjustment comes to $3,570,000. And goodwill for $1,229,500. For total assets of $17,043,000. Just like the assets, we combine the balances of the liabilities, $783,000 for accounts payable and $7,260,000 for long-term debt, as well as the equity accounts, for total liabilities and equities of $17,043,000. Did you notice that the final balances in the equity section are only the common stock and retained earnings for Monroe? And that is exactly what it should be, since we eliminated Maine Corporation's equity section. We now have the consolidated balance sheet for Monroe and Maine. So consolidation accounting isn't as complicated as you may have thought, as long as you know the required steps of adjusting, eliminating, and combining. For step 3, we also adjust for the non-controlling interest if the parent company owns less than 100% in the subsidiary. That's not the case here, and we're not recording any adjustments here. So that's a full process for 100% acquisition. Adjust the subsidiary's asset to fair value, record goodwill, eliminate the investment in the subsidiary's equity accounts, and combine what's left into one consolidated balance sheet. Adjust it accurately, eliminate it completely, and combine it into a single economic entity. That's it for this short video on consolidation accounting for 100% acquisition. If you're interested in more examples, acquisitions paid for by issuing stock, contingent terms, acquisition costs and process research and development costs, how to account for the sub in subsequent years, and acquisitions with non-controlling interest, watch out for the next videos where I'll cover more examples.